how much risk do you see potentially that ETFs has created a bubble? The ETF total AUM last year was exceeding 10 trillion at one stage. Is this really driving increase in asset prices in a bubble?
I mean, $10 trillion is incredible when you consider, and I know that's multi-asset, but you consider that the global stock market is $100 trillion. It's grown significantly. There are risks, of course, but look, at the end of the day, it's the product itself has, I think, been a game changer for financial services globally. You've got an index that you can invest in. It's not a stock like Kodak that can lose its relevance. It's an index that, in a way, is a portfolio strategy itself, always investing in the biggest and the most actively traded stocks of your market.
If you do consider buying individual stocks, you are taking a bet on just one single company. But if you're investing into ETF, you're investing across a set of companies through just one particular counter. And that itself gives you the diversification benefits that you would enjoy. And so therefore, it really gives you a lot more better protection. Because in some cases, one particular company may be doing a lot better during certain business cycle, and the others perhaps may be doing slightly less well.
Our Stage Street STI ETF, which launched in April 2002, has just surpassed 20 years old, obviously, having its 20-year anniversary this year. And then we had the other STI ETF listed, I think, February 2009. Now combined, it took 17 years for those two STI ETFs to reach $1 billion Sing dollars in AUM. Because of the volatility of March 2020 and for the remaining of 2020, we saw it only take another 17 months for the two ETFs to reach $2 billion in AUM. So the market volatility obviously plays a big role into it.
In terms of total return, which is basically with dividend reinvested, Nasdaq 100. That is index, focusing on the growth stocks in the States. So that's been struggling this year with the rate hike environment. That's down 27% year to date. And STI, but by nature of Singapore market, it is largely a value stock type of index dominated by bank exposure. That total return is actually even higher than what Raphael has quoted before, because here I'm talking about the total return with the dividend reinvested. Year to date, up 3.8%. So that is quite significant.
We've seen the number of retail investors who are active in our ETF market triple over a 3-year period, and the ETFs that are mostly participated in really reflect a very strong focus on both Singapore, the region, some cross-asset, as well as some risk management through the use of the gold ETF.
Given the market situation, we might expect more volatility. So I think investors need to stay nimble. Now, I guess the way to look at investing is having a core portfolio, right? And then you have a satellite approach to try to look out for potential other areas that you could generate extra return from. And that's where I think you can consider some of the regional theme type of ETFs, and you may want to consider also global, right? Because you never know that some of the global trends could also be very profitable over medium to longer term.
Now, other bright spots in the region, we have FTSE Indonesia. This index is focusing on the Indonesian equity market, so Indonesia has been benefiting from a stronger growth. This index seeing a total return of 8% year to date. And obviously, there's also on the other side of the world that we have FTSE Brazil. This index has gained over 20% because they have large oil company, commodity company like Vale. But as an emerging markets, investors need to be a bit careful, brace for the volatility, watch out for the valuation surge year to date in Brazil market.
Then you have the gold ETF, which does represent to the World Gold Council a great method to diversify a portfolio against volatility, because gold is ultimately the least correlated asset class to all the other asset classes, and hence has that still that safe haven status. World Gold Council suggests anything from 2 to 10% of a portfolio might want to be weighed to gold in terms of when you're facing volatility. So if you look at the 5 most traded ETFs so far this year, amidst the volatility we've seen in early 2022, you've got Gold ETF the most traded, the Spider STI ETF the second most traded, you have Kheng Siang tech stocks, you have the ETF that focuses on the corporate high yield bonds, as well as the China government bonds. Now that's very similar to last year, but the difference was we had the other STI ETF among our top 5, and the China government bonds were not among the top 5. But China government bonds at the end of last year were yielding 2.8%. I still think that's pretty competitive with the US 10-year yields.